All right, and we're live. It is now Tuesday at Startup TNT, lunch hour session. We're doing an investment prep video series with our good friends Tim Lin and Brendan Hance, both of whom help us organize Startup TNT and run their own consulting business called 4th Street Capital. Some local experts on due diligence, and we're working through best practices for telling a compelling story for your company. I believe we've had now 70 or more companies apply to the investment summit. We've got around 50 investors confirmed to participate, looking to get that up to 60. Applications due today. Hope everybody got their applications in. Really excited to get started. I've been anxiously watching them all come in, running the spectrum from people just starting out with their idea to a few companies looking to raise quite a bit of money and scale operations. So awesome to see all that activity happening. And the whole motivation here behind this investment series is that a lot of entrepreneurs tell us, building the data room and understanding how to tell the story and communicate the story to investors is one of the most valuable parts of participating in investment summits. And so we want to work with the entrepreneurs to make sure you're fully prepared and ready to enjoy the experience. So with that, we've got Tim and Brendan here. Tim, how are you guys feeling today?
Good, man. Look at how many people we have. This is awesome.
Look at this massive group. What are there? 18 people on the call. I'll assume there's hundreds watching in right now on YouTube Live. Great way to spend your lunch hour. Brendan, thanks for fitting us in. I thought you couldn't make it. What happened?
I was able to shift something around for you, Zach.
Wow, just for us.
Just
for us.
Yeah.
Thanks so much. All right, guys, I'm going to share the screen. Just for those, some of you might not have made it here last time, but just kind of give everyone a quick rundown. Tim, Brendan, and I kind of have a bit of a conversation about what goes into a good due diligence data room that you would share with your investors. For those of you that are just thinking about what a data room might be, think of it as basically a folder, like a Google Drive folder or a Dropbox folder that contains all the key documents that you would have about your business, why your business is set up for success, historical documents tracking, when you incorporated, all the basic stuff that you have in there so that you could share that with a potential investor to say, look, we've got everything under control. I've got everything figured out. I just need your money to make things happen. And so when the investor opens up the door and looks into your business, they're like, wow, these guys are really well organized. They know what's going on. So Tim and Brendan actually do this for a living. They investigate companies. They do due diligence on companies. They look at M&A activity, and they help companies decide on, or they help companies raise money, and they're preparing to raise money. And then they also help people decide whether or not they want to buy or invest in a company. So great local insights from these two. And they participate in our investment summit, help us organize it. So let's get right to it. Audience, it's here with us. You can throw questions into the chat as we go. And we're going to pick up where we left off last time. So we talked a little bit about the general due diligence process. We've talked a little bit about kind of that overview document that you want to make, corporate due diligence and finance due diligence. Now we're going to kind of walk through the rest of what we'll call business due diligence. And actually, I'm going to share my screen right now with a great document that these two have created called the Startup VDR template. All right, are we looking at it?
Oh, yeah.
So, very nice looking due diligence tracker. Okay, we're basically moving on to the cap table at the moment, or we're moving on to section 3, financing documents. Okay, first of all, just give us a highlight. What are the financing documents? What are you guys referring to when you talk about financing documents?
So, I mean, go for it, Brendan.
No, you go. This is your wheel. This is where you shine.
Yeah, sure. So there's another part of the financing document that's up in section 1 as well, and that's the financing, the documents that are associated with this financing. Like you shifted something around, but those proposed investment documents also land under this category as well. But this is essentially, the point is to highlight who owns what in the company, who the investors are, what the investment is, and trying to figure out what somebody would own at the end of the day. That's kind of the big goal of this section here.
Okay, so then help us understand how these documents tell that story. So let's start with the cap table. What is a cap table and what goes into it?
So cap table shares who owns the various interests in the company. So presumably the founders own shares. There's, employees that own shares or options. There's probably an option pool for employees. There's presumably some other investors, especially if we're talking about an angel round or an early venture round. There's probably friends and family investors at the very least. This document essentially outlines who owns which interests in the company and what resulting percentage ownership everybody has. And in a really good cap table, we'll forecast out beyond this. So it'll forecast out what this round looks like. We're raising 500,000 at a, $3 million pre-valuation. At the end of it, these investors are going to own 1/7 of the company, and kind of breaking it out. But then the really good ones will also forecast out, we're going to do a round next year and, one in 2024, and then we're going to exit. And this is sort of how the cap table is going to shift over time and what this is going to kind of look like.
And to Tim's point, the really good cap tables show like at what point investors have invested and in the future what it looks like. So like, having the dates and having everything lined up so that you can see it on a go forward basis is really, really helpful to explain your financing and how you plan on financing the business.
No, things froze for me. Zach, are you still there?
Guys, can you hear me? Everything froze for me. I actually left and came back. What's going on? Where are we at?
I think we're talking about cap tables.
I'm sorry. I might be having internet connectivity issues. Can you guys see
I don't know. Everything broke on Brendan's and my and your side. So I assume that I'll blame Zoom. Let's blame Mark Zuckerberg.
All right. I'll blame Zuckerberg. Sounds like a good answer. Okay, yeah, we were talking about cap tables, and I think you guys brought up a really good point that I would just want to emphasize, which is when you're raising money, like at the very beginning, your cap table is probably really simple, but it is a really important exercise to look through like how that cap table is going to change over time. So I think that's the real value as you're raising money for your first round and subsequent rounds, trying to figure that out for both you and the investors. How much will you get diluted based on how much money you think you need? So thanks for pointing that out.
And there's some, you can do it, you can try to put it together in Excel. There's various models that you can find on the internet. And there's also some free resources like captable.io that are available to show where you're at today and also help you forecast it out. So there's lots of resources to be able to put together something like this.
Yeah.
I think someone asked about convertible debt.
Yeah, I actually can't see the question. So if there's a question coming in, guys, you can just answer it directly.
Yeah. Timmy's asking
about, all right, do you want to answer that question?
So convertible debt, I mean, it typically would land as like it's essentially equity. And you have to make sort of a judgment call as to what it would convert at in terms of getting it onto the cap table as a percentage of ownership and stuff like that. But disclosing that there is convertible debt that has an equity ownership stake, or at least an option to turn into equity ownership, is important to have in the cap table for sure.
Yeah. And one thing,
the specifics on how exactly it would show up in there is, very.
Hey, Zach, did you freeze again?
Yeah, can you guys hear me? Okay, I think there's connectivity issues on my end. Okay, I'm gonna leave and come back in 2 minutes. You guys tell us about employee stock option plans and how much money typically people are setting aside in their cap table for employee stock option plans.
Yeah, there's another, well, on the point of convertible notes, it depends on how they're structured, and I've seen it done a few different ways where like, a company will raise a convertible note and pay out the interest. I've seen it where companies will raise a convertible note and accrue the interest, and that all goes into equity. And so when you're doing the calculation to figure out what the dilution will look like, just keep that in mind. If you're accruing interest, obviously all of that, the principal plus the accrued interest will convert to equity. And so, those calculations are super important depending on, the interest rate and how long the note is going to be outstanding. So keep that in mind when you're looking at convertible notes. I think Zach wanted us to talk about stock options, Tim.
Yeah, here, how about, I don't know, Zach, I'll try sharing my screen because I don't know, looks like when Zach does it doesn't work.
Okay, I'm using my cellular mobile hotspot. Sorry for these connection issues. I think I might be having like slow internet at home.
I don't know. My Zoom got blown up and it just restarted, so I don't know what happened too. But we got it here.
Okay, there's a lot to work through, but rapid fire. Employee stock options, what are they, and what's typical to set aside from your overall cap table for employee stock options?
Brendan.
Tim? So stock options is a pool that you set aside to be able to grant equity ownership, future equity ownership of the business to your employees. What's typical? I don't know. I've seen typically like 10% of the outstanding shares are set aside as options for employees. And you can do less or you can do a little bit more, but I think in that 10% range is a decent number.
Yeah, I've seen stuff between 10 to 25%. It depends on like how like crazy high skill the company needs to be from a human resource perspective, and like how they need to attract people. Like if you need like people that would typically be paid like $300,000 a year, and you're like, shit, not raising anything near that, you probably need to give them equity and you need to give them more. Your mileage may vary. But.
Yeah. One thing to keep in mind here is the valuation of the stock options, whether it's pre-money, based on pre-money valuation before you raise or post-money valuation before you raise. Sometimes angel investors will want to see it a particular way. And so, when setting it up, it's something to talk to your advisors about.
The other thing is what's also really good to the point of like going the next mile on the cap table, going the next mile on the ESOP and options plan is to have a forecast for who you're going to be granting those options to. You're going to be using this money to hire people. Those people that you're hiring are going to need options. And then with this 10%, we're going to be allocating them to these people, and they're going to be fairly compensated because this is all going to shake out at the end in a really good way. And that's 10 out of 10 on the option stuff.
Yeah. And if those employees are identified below in the human resources section as key employees, explain that using your options.
Mm-hmm.
Do you need a lawyer to help determine a strike price? You should talk to your accounting firm. You should talk to both your advisors, your lawyer and your accounting firm, because there are tax implications of granting options at strike prices that are lower or higher than the current share price. So I would work with the one thing that I've seen in a couple companies is they work with their lawyers to develop the ESOP program, and then they don't talk to their accounting firm, and then they grant options at the wrong strike price or whatnot, and it can have negative tax consequences if you don't do it properly. Negative tax consequences for your employees in particular, potentially.
Thanks for that, Brandon. All right, guys, tell us a little bit about what warrants are. What is a warrant, and why would we use one?
Tim?
Warrants are essentially options, but issued by the company. So I've seen situations, and actually this is one of the companies that we invested in the last summit. People got shares and warrants, or investors got shares and warrants in the company. So it's essentially, think of them as like the stock option plan that we're talking about for the employees, but given to investors. It's just a different way of capitalizing.
To buy shares in the future at a specific price.
Yeah, exactly. I've seen them. I've seen them sometimes granted alongside debt. So you might raise like $500,000 in debt, and along with those debt, every $1,000 of debt gets a warrant to buy one share in the company or something like that. And then those warrants are typically priced at an attractive share price that would allow you to buy equity in the business in the future. And so it's like it can be a bit of a sweetener for investors, but it does have a dilutive impact on your cap table. And so, anything related to financing you want to put in this folder. I don't think I've seen very many really early stage companies with stock warrants, but if you do have them, then put them in this folder.
Yeah, I've seen accelerators have them. It's like company deriving from accelerators. The accelerator will often have warrants to buy stock.
Yeah, and venture debt will as well.
Paul Dan, ask about thoughts on safes for raising a seed round.
Yeah, absolutely. Super easy, simple, as the name would suggest.
Yeah, and I would recommend people check out the Y Combinator website. It basically has like a great resource base on safes, templates for different types of safes, and very detailed explanations of why they're structuring safes a certain way. They're basically recommending as a new standard that everyone use what's called a post-money safe, where there's a valuation cap, and everyone kind of knows what they're getting when the safe converts to equity.
Yeah, and it's really hard for us to tell you what specifically to do. I mean, each company has a very specific requirement or need, and a safe note might not be in the best interest of one company, but it might work really, really well for someone else. So it's really dependent on your specific situation.
Yeah, and I'll add to that if you partner with a lead investor, sometimes that lead investor just has personal preferences and they want common shares with amendments for whatever reason, or they are more comfortable with convertible notes. So sometimes it's just a matter of all three of those things can work: a common equity, convertible note, or a safe. It's just a matter of working out the agreements that make the most sense for the parties at the table.
Yeah, absolutely.
The rest of the section is around liabilities. So security interest registered against the company, it's pretty broad, like anything that would show up on a title search. Debt financing arrangements. So a bunch of companies, especially post a seed raise, will get a debt financing arrangement with BDC or Silicon Valley Bank or one of the other kind of venture lending folks. Should disclose that, super important. And then grant financing will often have liabilities as well. So you need to perform on certain things in order to be able to, not have to pay it back. One of them is actually IRAP. If you sell your company within X amount of time, you have to pay back any IRAP money. And so that is actually a liability that's sitting there. For an investor, that would be like, oh shit, this is awesome. We got acquired in a year. Now it turns out you have to pay back $500,000 in IRAP. So disclosing your grant funding, it should definitely happen in this financing section, especially if there's an associated liability.
Yeah, and I think to the point of 4.6 here, when we say summary, put the grant funding arrangements and information pertaining to each grant funding arrangement into the Dropbox itself, and then put a summary behind it so that people understand exactly what you've gotten, and when certain IRAP fundings or when certain grant fundings might be running out and what those liabilities might look like.
Yeah, and also when you plan on getting them, some grants are milestone based. I've gotten in the past, we've gotten IRAP funding that was essentially I was going to get $200,000, and it was you get draw on it as you spend money, but it doesn't show up anywhere on your balance sheet or anything. Helpful to have those documents in a summary, to Brendan's point of the liabilities and also the grants that are coming down the pike, which would be super helpful.
Gosh, everyone's freezing again.
It's just you, Zack.
I'm not freezing.
No, we good now.
Yeah. So we can talk a little bit about human resources while Zack is frozen.
What do you think is this one's I think pretty thin. The employment agreements, a list of who you have, an org chart, the plan for who you want to hire. Zack's here again. Yeah, Brendan, where do you see people get tripped up on the HR side of things?
Identifying key employees, I think, is a really good one. I've seen issues with founder employment agreements that state like they have the capability to pay themselves basically whatever they want. They are allowed to bonus themselves whatever they want, and so those are like decent red flags for an investor. And a lot of times, some VCs will come in, and some VCs or some angel investors will come in and want caps on your wage or caps on bonuses, that sort of thing. But I think it's important to have, when you're going through a raise, I think it's important to have employment agreements in place, and make sure that they look decent. And there's lots of templates for employment agreements. You can get them on Law Depot. You can get them from your lawyer. You can get them from HR firms. I think it's a really good idea to have them in place. And then I also think that the other thing that I've seen a lot of companies do is like they don't really put a summary of who the people are or what they've done. And I think that's a really good thing to have. If you have 3 or 4 really key employees, put it in like a 1 to 2 page summary of their bios and what they've done in the past. I think a lot of investors put a lot of weight on the team. And so this is an area of due diligence that you can really highlight who your key employees are and what they're really good at and why you should be invested in. I think I actually spend an inordinate amount of time in the human resources folder because I like to understand who the team is and what they're up to.
Are you on this note, just in terms of like housekeeping for setting up data room, are you kind of expecting to see a folder called financing documents, a folder called human resources, and all these things are in those folders?
I mean,
like these folders are helpful.
Yeah, I would if I was doing this, I would take this spreadsheet. I would, there's some stuff in here that's going to be tailor-made to individual businesses, but I would take this spreadsheet, I'd put it in the data room at the very bottom, and I would have all these folders outlined, and then I would go in here and just like check off the stuff that you've done. So I'd take our data room and build out your own, and have it really organized so that it's a really good exercise both for you and for the investors. It highlights like certain gaps that you have in your, maybe I don't have employment agreements. Maybe it's something I should think about.
So thanks for that, Brendan, which reminds me, we will be sharing the data room and encouraging people to do just that. Every data room list, I should say.
Paul's asking this. Are we going to hook this up on the TNT website somewhere?
Yeah, we're going to, I think there's just, in the past, we've used a slightly different checklist structure, but I think with our friends here from 4th Street Capital, we will try employing this one this time around. It's structured in a very logical way. So we'll be sharing this with everyone who applied. We'll probably put a link to it on our website, and we're also going to share with the investors so that we're all working from the same kind of set of documents. And it should make our lives easy, all participants' lives a lot easier in terms of ensuring what documents are there and where. So yeah, we'll be sharing all that this week.
The one other thing that I would probably do in the human resources section is I'd put all this stuff as backup, and then I'd have a summary of employees, and I would identify the key ones. I would identify what they're currently getting paid. If you plan on giving people raises post raise because you feel like your team's under comp compared to market, put that stuff in. Put it in a nice like summary sheet so that it's just one click and someone can go in and be like, yeah, this is the team. And then have their bios sit beside it. I think it's all really, really good stuff that, it should be really easy for someone to find this information.
Yeah. And, I've seen a couple of companies like on the HR, on the HR folder, they'll have like a 1 to 2 page kind of summary document that sort of just overviews the HR strategy. I find that really useful too.
Yeah, absolutely.
Somebody asked, to typically accept it for founders to pull a salary. In my opinion, I think yes. And I think that there should be explicit permission from the investors to grant that permission, because otherwise, having been in that position or making no money all the way through, it gets really, really stressful for founders. And they frankly need to allocate their stress in more appropriate ways, like to build the company instead of being stressed as to what they're going to have for dinner.
I would say absolutely you should pay yourselves. I have seen a couple companies though, and this is a huge red flag for me. Like, if the founders don't have anything invested in the business from a cash perspective, and then they're also compensating themselves like, you know, $200,000+ a year, I think that doesn't sit well with some people. You know, some investors don't care. Some don't like that kind of thing. I'm on the latter. I think like pay yourself a fair wage. You know, it looks really good, and like you're committed to the business if you have some money invested in the company, not just sweat equity, but some actual cash. And all of that, I think, looks really, really good on you as a founder. Shows that you believe in the business and you're managing it prudently, and you're not just going to take investor money and run.
Yeah, and to the point of like a living wage, I think this, you know, important to Brendan's point. You know, 200 grand a year is obviously egregious. Like for a seed round, raising, we'll call it $1 million-ish, or a pre-seed, whatever we call it now. At this point, it's almost friends and family. $1 million, you know, 60 grand or so per year for the founders, where it's like a living wage, but it's not like enough to allow for savings. You know, what investors want is alignment with the founders, and the founders to be aligned with them. And you know, what you want is to not be sucking the cash out of the company and plunking it into, you know, other investments. What the investors want is for you to be wholly invested into this thing and alongside them for the ride, and not letting it die, being, you know, forced to make it grow and see things happen. So
yeah,
it's a bit of a balance, but.
And maybe I would summarize it from my perspective. Generally, you know, you're raising money to build a company. Some of that could go towards the salaries of the founders, but I don't think it looks good if the majority of it, or a too large of a chunk, is being used just for founder salaries. So,
yeah.
Someone
Proceed
asked
to
where
the cap table. To answer the question, where does the actual cash that's been invested as a founder show up? It'll show up in the cap table.
Well,
yeah.
So it could be equity. I've also seen, you know, just like nominal priced shares for the founders, and then you've made shareholder loan contributions. Again, I'm a big fan of founders that have cash committed in the company as equity. And so one of the considerations there might be you convert your shareholder loans, or a portion of your shareholder loans, into equity, you know, to show that you're committed to the business from an equity perspective. Some investors might ask you to do that. Some investors might be okay with having shareholders' loans sitting on the balance sheet that can be repaid. But I think like just recognizing that you might have to answer that question if that's the case. And again, you know, I would have, if you're looking at financing documents, I would have your shareholder loan documents recorded, and I'd have your shareholder loans recorded as a loan. So you can work with your accounting firm and your legal advisors to do that.
Yeah, I mean, I'd say the more investor friendly way, and if you're trying to attract investment, that, you know, being more investor friendly is the way to go. You know, the more investor friendly situation is to have your shareholder loan converted into equity. So otherwise, you have debt sitting in front of you. Like, you can raise the money, and then you can just like call the shareholder loan and walk away with however many hundreds of grand you put in, and walk away from the company. And that's not what an investor would like to see. Zack, how far down are we wanting to go on this?
You know what? Why don't we spend like maybe 5 more minutes? Because I don't want to go we go over time every time. So let's just go 5 minutes over time. And let's just talk about product development. Because actually, honestly, in your list here, there's a couple things in here I don't think I have typically seen, at least on our old data room due diligence checklist. So detailed description of the spend on the product development so far. Talk about that. Why you have that in there?
I think it's informative.
Go ahead, Tim.
So I think that it's informative to know, while past results don't dictate future performance, I think that past results are informative of how the founder thinks and how they will perform in the future. It's helpful to see how they think. It's helpful to see what they've spent and over what time frame they've spent it, to know what the cash burn is in the product development, and whether there's actually been development and who it's been spent on, and all that type of stuff. And then it also provides some insight into how the founder and the team thinks about product development, because unless they recognize that there's a whole pile of mistakes that have been done to date, it's probably, going to be more of the same that'll be done with this cash. And so this is like, proof is in the pudding. You want money in order to build your product. What's happened so far, and how's this going to happen with the money that we're giving you?
Yeah. Okay. Great points. Brendan, anything to add to that?
No, I think that's exactly it. I've looked at lots of companies who, it's like, well, how have you, what have you spent this money on to date, and like how have you gotten to where you are today? And like sometimes it's a really difficult question for people to answer because they haven't thought about it. And so I don't know. I think it's a really good way to demonstrate where you are in the product development life cycle. If you spend $500,000 and you're at TRL 2 on like a hardware, and okay, well, explain that and show us sort of where you are at in terms of product development.
Right, and why that makes sense. Which for certain hardware, it might actually make sense that that's how much it costs to get there. But you want to make sure you can convince everybody or just explain to everybody why that is. Okay, a couple of questions coming in from the chat. Actually, why don't I ask my question first, then you guys answer those questions coming in from the chat. My
Sure.
question is, well, the first line there is basically looking backwards at what they did with their product so far. Next line is looking forward. So just elaborate for us there. Like, what are you putting in that kind of like product roadmap section?
So this one would be, this is highly dependent on what the company is, right? Like, I don't know, we could run through examples, but like you're raising money presumably to either develop product or build out the sales and marketing channels. So assuming that it's to build the product, and usually those are not mutually exclusive. Even if you're going through sales and marketing and that's what the most of it is for, you're also presumably building out product in order to capture more of the customer base. What are you planning on doing with the money is essentially the thing here. And not only what are you planning on spending this money on, it's also, to this point, what are sales and margin expectations for those products that you're developing? It's like, are we making smart business decisions as to how this is going to work out? We're going to spend $5 million over the next 3 years in order to build a product that we think is going to generate $1 million a year at 30% margins. Like, well, okay, this is a waste of time. I'm not investing in this. Like, don't do that. This I think is getting people to articulate it very, very clearly, as opposed to, an investment deck that's mostly about showmanship and hype. Getting people to really put it down on paper as to what exactly is going down, I think is important, so you can remove the emotion from it.
To back up the kind of predictions and the excitement that you're building in the deck, like here's what that's like under the hood. Sure.
Yeah, I've seen this in like a timeline, and I think it articulates it really well. But there's lots of ways to do it, and you could just have a 2-page slide, 2 slides or something like that go into more detail of like what your product roadmap looks like, and what you plan on spending future money on. And it's a really, again, like these are questions you might get asked. It's really good to have for investors, but it's also probably really good to have for yourself as an entrepreneur to think through these things.
Yeah. And on that last point there, breakdown of revenue or expected revenue, I guess that's historical, but also expected revenue, I would just add to that, of product by brand is also super.
Yeah. Absolutely.
Yeah. And some of this, like I said,
questions in the chat, and then let's call this a wrap for today.
Let's do it. So it would be recommended to recognize the mistakes made at the beginning of the journey from the perspective of product development. I'm assuming. I'd say yes. Like I would say, we spent this money, we spent it on some dumb stuff that we probably shouldn't do again. Like, to show that you're learning. The motto of the Valley is move fast and break things. The idea isn't to be a bull in a china shop. The idea is to break things, learn that you've broken it, and then not do that again. And yeah, I'd say that recognizing the mistakes very overtly would be helpful. And frankly, I think that if it's an investor that says that you shouldn't be making any mistakes, you probably don't want them on your cap table because they don't know what they're doing.
Yeah,
they just made a huge mistake by saying that or holding up.
Yeah. I think I think a lot of investors are really interested in investing in founders that have the capacity to learn and are coachable. And I think if you recognize those mistakes and you're able to articulate that, like, hey, you know what, we made an error here, we backtracked and we fixed it. This is how we're going to move forward. I think that's all positive stuff. Benji's asking about the best way to assemble a board. This is a really actually tricky question to answer on a 30-minute lunch call. But there are, I wish I had Zach, maybe you can send out an email after. There's a really good book that I've read on this advisory board type stuff And Zach can send it out to the group if people are interested in this.
Yeah, maybe it's something we dive into a little bit next week as well.
Yeah, my only general guideline for actually this kind of a standard question is like, you're building a new relationship here. So, is there a way to test out the relationship before you sign them up for a board of directors seat where they're getting employee stock options and they're having a pretty big impact on your company? That's my general.
And I think like you need to look at your company and where you see the gaps and then augment those gaps with advisors that have experience in those areas potentially. And it's also good to have people on your advisory board that just have like really solid general business advisory experience, I think.
The other thing here, I'll just throw this out. I'll throw out a plug to our next big event that I'm excited about. Other than pitch night for the top 20 companies in each category next week, the following week is going to be alumni night where we can pose some of these questions to our alumni, Benji. We can say, hey, what approach did you take to building your board of directors now that they've built one? And, we can learn lessons from that.
This is actually a great question for the entrepreneurs. Yeah. I think like you'll have a whole bunch of people that will be able to provide really good advice on this.
Yeah. Okay. Last quick question that I'm seeing here, 10 million shares versus 1 million shares. Any thoughts on the actual number of shares?
In my opinion, I think that if any sophisticated investor is looking at how many shares there are, they're not quite a sophisticated investor unless I'm missing some sort of weird nuance.
Well,
nobody's investing off of the price per share of your thing. It's based off of the valuation on a pre-money, post-money cap in the millions of dollars, not on, I get in a cent per share and I'm going to sell it at 10 cents a share. Yeah. Nobody's looking at that.
One piece of advice I've heard on this, which take it or leave it, is, if you have something like 10 million shares, when you're giving away shares to a board of directors as a thank you, you can give them a pretty large number that sounds nice, as opposed to if you only have like 1 million or 100,000, they're getting like 15 shares, as opposed to like 1,500 or 15,000.
And especially to employees, speaking of, people who are relatively unsophisticated in the financial space, typically, again, to Zach's point, you get 100,000 shares. Oh, wow, that's a lot. If you have 100 million shares, it's kind of an irrelevant number, but it sounds really cool.
Yeah. But again, coming back to, work with your advisors on all of this stuff, like not just your lawyers, also your accounting firm. So if you're issuing shares, talk to your lawyer, talk to your accountant, make sure everything is above board. I think that's a really important thing. I've seen a lot of entrepreneurs just do stuff just with their lawyers and not consult with their accountants. And I think they go hand in hand and they're key pieces of the puzzle when you're doing this kind of stuff.
Yeah. And honestly, I love talking to entrepreneurs that maybe did this 6 months ago or did it 2 years ago and getting their input on what worked and what didn't work. Great. Okay, guys, let's end it here. Are we setting up office hours? We talked about this last week. A couple of things we talked about we haven't done yet. Are we committing to office hours for these guys on Friday afternoon? What's your schedule?
Let's do it.
Yeah, I'm good until 3. And then assuming it's not raining, I'm going to be at Dusk. So if somebody wants to accost me in person, I'll be at Dusk. But
all right, so guys, we're going to give it to this to everybody on the call today. We're going to send out an email this afternoon about the office hours. You can meet up with Tim and Lynn, ask some more questions. Tim and Brendan. You can ask more questions about these things one-on-one or in a small group setting. And then we'll also share this Excel sheet to help you guys start organizing your data rooms and working through it. Okay, let's end it there. Thanks so much. It's a great afternoon. Great
Good work.